December 11th, 2023. We had a doji on the open today, and whenever you have a doji on the open, it just generally increases the chances that you're going to get a lot of trading range trading. This is an example from a little earlier this year. And there's, I should have a couple other examples. This was today, and then this was only a couple days ago. I mean, basically a doji on the open. And, relatively, they're usually types of trading range days. They can be trending trading range days, obviously, like today. But generally, days that there's a doji on the open, you want to be pretty cautious with your entries. A bull bar on bar two, but it's probably going to get bad follow through. When you get a doji on the open, like I said, it's probably going to be a trading range day. So bulls are hoping this was one, pullback two, and a strong bull bar on two, micro double bottom with one, and that we're going to get a big second leg up from this. Bears are thinking that this is strong enough that we're probably going to get, at least a little bit more of the downside, and that two is probably going to have disappointing follow through. And if it is a trading range day, two will have disappointing follow through. And you can see that's exactly what happened on three. We got bad follow through for the bulls who bought above two. Bar four, if you bought above two, you're disappointed in three and you're exiting around break even during four. And then five is a micro double top with three, or you could argue it's a micro double top with four. But it's a tight trading range, right? Three, four, and five all have the exact same low. And we got a failed breakout above the high of the tight trading range. And now we're going to try to get a breakout below the tight trading range. I think it makes a lot more sense in this context to just wait and see if you get a big bear follow through bar. And if you do, then great, you can sell that. But, the reality is you're probably not going to get very good follow through if you're selling below five. And the traders who did sell below five, you can see they were able to scalp with 4 points, but not quite five. So, disappointing. And you can see, bulls were probably willing to buy around the open of the day. And, any bulls who were buying down here were probably willing to scale in lower as well, knowing that we're probably going to test back into this tight trading range because tight trading ranges usually get tested. Six is a big bull bar closing on its high, and it's a double bottom or near its high, and it's a double bottom with two. But I don't really want to buy above six. It's a huge bar, so the risk is really big, and you're at the top of a tight trading range, so it's probably not all that good. What more traders will do is they'll look to buy a pullback, so maybe around a 50% pullback of the bar. That's what a lot more traders were doing here. You can see that. And generally, when you get big bars, traders are more interested, especially in a trading range, when you get big bars, traders are more interested in buying the 50% pullback. Even look at bar eight. What happened on nine? Traders bought the 50% pullback, pulled back to their entry price, they scalped out. So some traders who bought actually, let me just get there. So six, a bull bar closing its high. Like I said, traders bought the 50% pullback. And then we got up here, but that the traders who bought above six probably aren't going to hold on to their trades, so they're going to scalp out, which is one of the reasons why you're getting a doji on nine. And 10, there are a couple of ways to manage buying above eight. I don't think it's a very good idea to buy above eight, be disappointed in nine, and just get out at break even during 10. You can do that, but the reality is, you're probably going to face a lot of bad follow through if you're buying above a bar like eight. So I think you need to be willing to scale in if you're going to buy above eight. And some traders bought above eight and they scaled in lower at the 50% pullback, and then they exited their initial price around break even along with the piece they added on, which is fine. But it probably makes more sense just to buy lower rather than buying above eight, because you're buying essentially a third push up, one pullback, two. I would argue it's more one pullback, two pullback, three. So it's essentially a wedge, and you're buying the third push up in what's probably a trading range, right? And if this is going to be a bull trend, every once in a while, maybe 30% chance that buying above eight is going to lead to a strong bull trend. And if it's going to do that, you're going to get a good follow through bar, and you can just buy the follow through bar, or you'll get two good follow through bars, and you can just buy one of those follow through bars instead of buying directly above eight. So you get bad follow through on nine, and then another doji on 10, and then you get 11. You could, bears are arguing it's a wedge and that they want to sell below 11 for a swing. But my problem with selling is that you're right on the moving average and you're following two doji bars. So I don't really think it's a very good idea to sell below 11. They're also arguing it's a double top with nine. It's a bull channel at this point. So bulls would argue it's the spike on two, and this whole thing has been the channel for the bulls. But that's not a very good argument either, because we're very sideways. So when no one has, when there are arguments for both sides, but neither one is all that great, I think it's a lot more of a trading range. It's likely. If you did sell below 11, you was essentially hoping it was double top with nine, and the neckline of the trade is the 10 low. If you sold below 11, how do you feel about 12? Is that really what you wanted to see? If you're selling below 11 after two dojis right on the moving average, you should be pretty nervous while you're taking that sell, meaning it's low probability, and you can get trapped pretty easily taking that kind of trade. And so I think a lot of the traders who took that, they see 12, and what they really wanted to see was a bar like 20. They wanted to see a giant bear bar trapping all the bulls in who bought below here, and forcing bears to sell a lot lower, forcing bulls to get out of their longs a lot lower, and driving us into a big bear trend. 12 really isn't that. 12 is just there weren't as many buyers below 11 because traders, a lot of bulls aren't willing to scale in below a bar like 11 because occasionally it will go, but it's not likely enough that I think it's a very good sell. So you get bad follow through, somewhat bad follow through on 12, and you're also back in the middle of this tight trading range, this overall really tight trading range. So I really don't think it's great to still be short on the close of 12. And you can see a lot of traders thought that because as we traded down below 12, bears who sold below 11, I don't know if they even got 1-to-1 of their true risk. They got almost exactly 1-to-1 of their true risk. So if you sold below 11, your stop would have had to be one tick. Your stop would have had to be right here in order to not get hit during 12. You don't know that until after the trade's already going. But the point is, your actual risk on the trade would be if your stop was there. And your entry is one tick below the bar 11 low. And you can see traders who sold below 11 were disappointed in how 12 closed. And so what they did was they looked at where 1-to-1 of their true risk was, which was right here. And you can see 13 went one tick below that, meaning that as soon as traders were able to get filled, it has to go one tick past your entry price in order for you to get filled generally. And as soon as these traders on 13 were able to get filled at exactly 1-to-1 of their true risk reward, they just exited the trade. And that's what causes all the buying pressure on 13. And that's a pretty common thing to happen when you have low probability trades that get this type of follow through. Traders just look, well, what's my 1-to-1? All right, I'm going to get out. And that's what causes the big bull bar on 13. Do you buy above 13? I don't think so. You're trying to get a breakout above the wedge. So essentially this is a wedge and bulls are hoping to get a breakout above it and a measured move up somewhere up here. But 13 doesn't close above the top of the wedge, and you have 3 straight bear closes in a row. And if stop order bulls made any money yet today, I mean, show me a spot where you bought on a stop and you've made money today. You really haven't. And bears who sold below 5 could have made a quick scalp, but that's it. So pretty much every single stop order trader has lost money so far today, constantly, and limit order traders are making money. So do you really want to buy at the top of what's probably a trading range without a breakout? And there are problems with the trade when stop order bulls aren't even making money today. It's just limit order traders making money. And so that's not why it's not surprising you get bad follow through like 14. What about selling 14? Well, I think, you can see that we have a clear, channel line going. So we have a relatively clear bull channel here. It's not a good one, but it is a bull channel. Bears are arguing it's a wedge and it's a lower high with this. And this was all, so they want to say that this was a trend line break from here. And now we're getting a lower high and some sort of major trend reversal. And we might be, but if that's going to happen, 14 is not going to be your only chance to enter. If this is going to be a major trend reversal, it can trend for 20, 30 bars. So you don't need to sell below 14. If 15 is a strong bear close, you can sell below 15. If you don't want to sell below, if 15 is a strong bear close, but you still don't want to sell, wait to see if 16 is a strong bear close, then you can sell that. So there's no rush to get in because no stop order traders are making any money yet today. So I don't really think, there's a reason to try and get in. And additionally, 14 has a tail on the bottom, right on the moving average, and stop order traders are just not making any money today. I don't even know. Could you have made a point? Yeah, selling below 14, you could have made 1 point. Is this really the kind of environment you want to be trading in? And traders get doji follow through on 15. A lot of them exit at the market, and we get a breakout above the top of the wedge and above the prior day's high. However, a lot of times when you break out above the prior day's high, you're going to get bad follow through. And, on a day like today too, we're generally kind of overbought. And then, I've been thinking we're probably gonna have to pull back. And usually this bar is not going to get the best follow through to the upside. So that's why I thought it was kind of, not a great trade to buy the close of 16. It's notable though, that 16 closed above yesterday's high. That's good for the bulls, and obviously closed above an obvious breakout point. Also good for the bulls. However, 15 being a doji bar is the signal bar, and this is probably a trading range, so we might have to test back down. So I thought 17 was a pretty important bar. If bulls could get, a good looking bull follow through bar on 17, we'd be very clearly always in long and probably going higher. However, we got kind of disappointing follow through on 17. If you're a bull, you wanted 17 to close on its high, and you ended up just getting, a bar with a tail on the top, a tail on the bottom, and it's not a very big body. So it just shows a lack of urgency for the bulls on bar 17. And then you get an outside down bar on bar 18. And if you think about it, if you were trading from an always in perspective and you were long in here for any reason, and then you got bar 18, what are you thinking? You're probably thinking, oh, I need to get out. This is not good. I want to get out because it's too likely that, well, A, it's bar 18, right? So it's more likely that there's going to be a reversal. And sometimes on bar 18, you'll get a big reversal and it'll break out to the opposite side. I think I have some examples. Bar 18. They'll break out of the 18 bar range, sure. So you can see here, we tried to get a breakout of the 18 bar range. We failed, and then we got a breakout to the other side. This is actually a good example. We tried to get a breakout to the upside, and then we failed, and we got a breakout down to the other side. Here, we did break out to the upside of the 18 bar range, but we failed above essentially yesterday's high and kind of failed above the 18 bar range, and then got a big sell off to the downside. So you can see the risk the bulls face here. When you're getting a failed breakout of yesterday's high as well as a failed breakout of the 18 bar range on bar 18, it's very possible that we start to get a sell-off. So I think bulls are going to exit below 18. I think 18 is a reasonable swing short. Your problem is 16 and 17 are strong enough to probably get a second leg up. So it might not go straight down, but I still think 18 is a reasonable swing sell. It was probably the best stop order trade on the day. 19 trades up to the 17 close. So traders who bought the close of 17, disappointed 18, able to get out around break even during 19, which isn't great for the Bears. Bears were hoping to trap those bulls in and force them to exit lower with a loss. But you can see any of those bulls who were buying were selling immediately. And then any bulls who held and were hoping, saw that 19 was, up near its high, they were thinking, well, maybe it'll close strong and we can trap these Bears. They saw there was a tail on the top of the bar, and they just sold out of their longs on the close of 19, disappointed that, this follow through on 19 was not as strong as they wanted it to be. 20, a big bear bar closing near its low. Bulls are hoping it's a second leg trap. Bears are thinking that, so bulls are hoping 1, pullback 2, and we're going to get, a rally. Bears are thinking that this was a breakout pullback on 19, and we're starting to swing down on 20. Good follow through for the Bears on 21, but you're kind of right back into this tight trading range. So while it's reasonable to sell the close of 21, you have to be aware you're probably going to have to sit through a pullback, and it might be kind of a pullback you don't really want to sit through. 22, a bull bar. I think it's okay to just get out above 22 if you're short. There's too much risk. This is a trading range, and we can test pretty easily all the way up to the 19 low if this is a trading range. So I think it makes sense. I'm just curious on how much of it you want to make. So 3 points. 3 points is probably a reasonable scalp on a 15, 16 point day at this point. So probably reasonable for always in Bears to exit above 22 and look to sell again lower. 23 outside up bar, but a big tail on the top and a big tail on the bottom. So, I don't really want to take anything here. I think we're more sideways. Bears are looking for a bear bar closing near its low. But if you get that, the problem is it might be a 1 pullback, 2 pullback, and then you'd be selling a third leg in what's potentially a trading range. I think if it's still clearly always in short, then it's fine. But sorry, I had to pause there to refill my water. I think I was on bar 23. So it's an outside up bar, and bulls are seeing it as essentially a micro double bottom and thinking we're going to go higher. And then when you get 24, I think 24 is a really important bar. So bulls are seeing 3 straight bull closes and thinking that, the first reversal down, so any reversal down here is probably going to fail. And bears are seeing that it's 1 pullback, 2. So it's, 1 on, it's a 2-legged correction essentially in their bear trend, right? This is their channel line, and it's a 2-legged correction. So the Bears see that it's leg 1, and then 23 pulls back below 22. So it's an implied pullback, and then 24 trades above. So it's a 2-legged correction. And then you get bar 25, and it's a big bear bar closing near its low. And if you're a bear here, what is your argument, right? You're hoping that this is, essentially going to be a big breakout to the downside, and you're going to get big follow through. And if you're a bull, you're hoping it's 1 pullback, 2 pullback, 3, and this is a wedge, and we're going to get some sort of at least 2 legs sideways to up is what you'd be hoping for. But I think if you're a bear, you need to look at the fact that there was 3 consecutive bull closes. Why are there 3 consecutive bull closes? This is pretty early in this bear trend. If this was going to be a bear trend, you're still pretty early into it. You're, 6, 7 bars into it. So why are there, 3 consecutive bull closes? I think 1 was fine. 2 was probably still fine, but 3 consecutive bull closes is a big problem in your trend, especially when, you didn't get a humongous sell-off. 20 and 21 are strong. They're definitely strong enough for a second leg, but this is disappointing for the bull or for the Bears. So I think what a lot of bears thought here was, well, this could just be a third leg in a trading range, and what I'm seeing, I would rather just take my profits. And if we get a bear bar closing near its low, I can sell again, no problem. But you also got to keep in mind the bulls who bought below 24 did a reasonable thing since it was 3 straight bull bars. So they probably bought here and they scaled in lower, and they're probably going to get out around break even. So those are all the things that are going through the mind of the bears when they see 25, and that's why they just get out. And I think 26 is just bears exiting their shorts, and that's why these bars can get so big so fast. Is because traders start to exit, and then traders see that other traders are exiting, and they just start panicking out. And bulls are seeing the bears panicking out, and so they're buying at the market. 27, an inside bear bar. It's essentially a low one, but I'd rather just wait. You're getting inside bars. It's a tight trading range. Just see the follow through. 28, another inside bar, so it's an I pattern. When you get that many inside bars, we had it earlier. We had it last week here. Where was it? I thought it was that day. I could have sworn it was last Wednesday. Maybe I'm wrong. We had an II with a failed breakout to the upside last week and then a breakout to the downside. My overall point being, when you get an III, just better to wait for the breakout. You can see we got a breakout attempt above on 29, some follow through, but you're hoping for a strong close above here. 30, more follow through for the bulls, so bull close. 31 tests back into the apex of the triangle. So, an III pattern is, I'll draw it over here because it's easier to see. But you can see it's just that shape. You can see that shape right there. And it's really just a triangle on a smaller time frame. So if you go to a smaller time frame, so we'll look from 11:30 to 11:45 on the 1 minute chart. '30, 11:45. On a 1 minute chart, it's just a triangle, right? So all that means is the market is contracting and that you're probably going to get a breakout soon. So like I was saying, good follow through for the bulls, and 31 tests the apex of the triangle. Oftentimes the market tests the apex of the triangle. 32, bad follow through for the bulls who bought above 31. Stop order traders really, in general, especially the bulls today, haven't gotten really good follow through on any of their stop order trades. So you should be expecting kind of bad follow through in general today. 33, a bear bar closing near its low. It's, bears are hoping it's 1, pullback, 2, pullback on 31, trading below 30, and then a wedge to 33. However, you have 5 straight bull closes and 33 closes near its low, but doesn't it make a lot more sense to just wait and see if 34 is a strong bear bar? If 34 is a strong bear bar, then great, you can sell below 34, but 34 ends up being a doji bar, so any of the bears who sold below 33 disappointed 34 for getting out break even during 35. Makes sense. 36 trades down. Traders who were short for any reason, if they were short and they scaled in, they're getting out here. Probably buyers below 35 as well. But it could be 3 pushes up. I had a lot of trouble with this rally. It's hard to get long in situations like this. And like specifically, by the close of 36, it's probably always in long, but you also know that can change really quickly with pretty much any bear bar. So I suppose one strategy would be to just buy at the market, throw a stop below, on the close of 36, maybe below 34 or 31 at that point. Definitely 31 would be fine, but maybe 34 would be fine. You can just buy one of these closes and just put a stop down there and hold until you get that bear bar that flips the market, and you wouldn't ever end up getting stopped out here. So that's one strategy. And I think that's probably the right thing to do when you're starting to see a tight channel forming. Like this channel was obviously pretty tight. That's more of a theory of mine, though. I'm pretty sure that that's correct, but it's not something that I do because I'm not comfortable enough or good enough to do that yet. I just really try to stay in my comfort zone as much as possible. So follow through for the bulls on 38, a good bull bar, but it's trying to break out of a trading range, and it's essentially 3 pushes up. Some bulls would argue it was 3 pushes up to the inside bar on 37, and we're getting a breakout above the wedge. And you're getting basically a breakup pullback on 39. But bears would argue that it's just another leg up, and this is probably going to come to an end pretty soon. 40, a bull bar, but a big tail on the top. More follow through on 41, lots of tails. Again, this is just a tight bull channel at this point. Bears are hoping it's going to turn into a wedge around this high, and we're going to get a failed break out of the 18-bar range in an attempt at a sell-off down. And bulls are hoping that it's, a type bull channel, and we're going to get a larger rally. 43 changes kind of the whole character of what's going on. It's a big outside up bull bar closing basically on its high, and it had a big tail down, and it essentially resets the market cycle here. This was trapping out a lot of the bulls who had weak stops, who were trailing stops, and now those bulls are trapped out, and they're thinking that, oh my gosh, I just got trapped out. Is this about to start to rally? But you have to keep in mind, when you're seeing 43, what have bulls done every single time we've gotten a big bar today? They're buying the pullback of the bar. They're buying the pullback of the bar. They're buying the pullback of the bar. They're buying the pullbacks, right? So traders are buying pullbacks of big bars today. They're not buying directly above them. So you can't, if you're buying above 43, you can't be surprised when 44 is bad follow through and 45 is bad follow through, because traders notoriously all day today have been buying pullbacks of bars and not directly above them. Bull surprise on 46. You're not expecting to get a bull bar that's that strong. The 45 high might become a magnet. We never reached it. And then we got, follow through for the bulls on 47, breaking out above the high of the trading range. Bulls would argue it's essentially a spike, pullback. You could argue it was, the channel started here, but I thought, once we started getting up into here, it looked more like this was the spike. This whole thing was the spike, because this ended up being a channel off of the spike from 46. But regardless, this is a channel phase. So bulls, selling highs instead of buying them. And it's just not as strong as it could be. It never really is on days like this. It's always in long. So I suppose if you're an always in trader, you can be holding. And then you get disappointment on 58, big bear bar closing near its low. This was essentially 3 pushes, right? 1 pullback, 2 pullback, 3 after that spike. And then, 58 closing near its low. I thought that once we started to get 59.60, I thought this was strong enough that it convinced me we were in a trading range and the channel wasn't really that active anymore. So I thought even if we traded above 57, there would be sellers, and definitely traders who sold above 57 were going to be able to make money. And that's one of the reasons 61 basically tested the 57 high, and we found sellers. Pullback, you could argue it's 2 legs, 1 pullback, 2, but a decent enough pair of bear bars that buying above 64 is a bad idea. And you're also just buying in the middle of a tight trading range in general, which you just don't want to do. You're buying exactly in the middle of a tight trading range. So not surprising there's bad follow through on 65. If you're doing that, you need to be willing to scale in a lot lower. Disappointing follow through on 65. If you buy above here, you're probably going to be let out at break even, but you need to be willing to scale in. You can't just have a stop down here or even down here, because it's not going to go well. You probably want to have a stop like all the way down here, at least I would think, if you're going to be scaling into this. But for the record, that's not something I do. So those are just, things that I'm pretty sure of. I'm not sure exactly where your stop placement should be if you're scaling into this trade, because that's never something I do, but I assume it would have to be somewhere down here. Tails on the bottom of 65, 66, 67. So it could be essentially a parabolic wedge. Big bull bar on 68, letting the traders who bought above 64 out at break even. 69 trades down to the 67 close, where traders who sold the close of 67 are let out at break even. And then we eventually get back to this close, so those traders can get out, and it just goes sideways essentially for the rest of the day. I think once you get 58, I think it was reasonable to be holding long through this, as if you're an always in trader, just be holding long, hoping you're going to get an endless channel essentially. But once you get 58, you got to look for a way to get out, since your premise isn't really valid anymore. I think that's why a lot of bulls were exiting over here. And I don't think any of this is really good trading towards the end of the day. All of this, once you got this, you have to be thinking this is now a trading range, right? Once you see 58, this has now become a trading range. It's not a trend anymore. And so all of these entries are not that good. And I would just be flat for the rest of the day. I think stop entries, I thought 18 was good. I wouldn't buy the II. Maybe someone would. Some traders would, but I would just rather wait for the breakout. So with that being said, I assume it's logical to buy one of these closes, and just once it's always in long, it's probably okay to buy one of these closes and just hold. It was probably okay to buy above 46 because it was surprising enough for a second leg. It's maybe okay to buy above 43, but you might get a deep pullback. Also notable that if you sold above 42, you got trapped and weren't able to get out on the close of 45. And so that's another reason why traders might be buying above here. I wonder if I'm just going to check something. So to those traders who bought above 46 were able to make 4 points, not 5. There was a lot of scalps for 4 points today. This was a scalp for 4 points, selling below 5 and not for 5 points. Selling below 4 or 5, traders scalped out with 4 points. So things like that will set the tone for the day as to the size of the scalps. So I think that's one of the reasons why traders scalped out with 4 points up here. On the daily chart, we have 3 straight decent bull closes, which is notable because now that we have 3, the first reversal down should fail. I still think the traders who sold above here are going to end up making money. I'm kind of expecting disappointing follow through for the bulls tomorrow. We could start, we could continue this channel up, but I think we're on the channel line here. And I'm kind of just expecting disappointing follow through for the bulls in general tomorrow. And we're probably, first things first, we have to get back to the breakout point, either here or here. But I do think the bears who sold above this high are going to end up making money. And yeah, that's pretty much it.